Gains across the board on Wall Street as the Trump-fueled rally drives the Dow and the S&P 500 to new highs here. And our next guest says that even though the market technically qualifies as a bubble right now, it does not look toppy. Joining us now is the Leuthold Group Chief Investment Officer, Doug Ramsey. Doug, it's good to see you. Let's start there on that point, Doug. You say what we have here is a genuine stock market bubble. How so, Doug? Quantify that for us.
Probably back in February, March, we designated some levels on various valuation measures that we just drew a line historically and said, look, whenever the market has traded north of 21 times forward earnings, it's been in a bubble. So I'm talking about 1999, 2000, and then again in 2021, the mania following the COVID bailouts, right? When it's been north of 18 times cash flow historically, it's been in a bubble. It's 20 times today. We do something akin, you may talk on the show about the Shiller PE ratio. We've got something similar. We don't call it the Leuthold PE ratio. We should, but it's a 5-year smoothing of earnings. So our normalized PE ratio, as we call it, is 32.5 times. Every time you've been north of 30, you've been in a bubble. So really just looking historically, just using simple line drawing techniques, we're just saying, look, when you've been here before, you've been in an equity market bubble. So now every one of these metrics, and there are a few more I won't get into, but all of them are now trading at levels which have never been seen outside of bubble zones. So I think we're there. I get that maybe the enthusiasm from the retail crowd is not maybe what it was, for example, during the internet bubble, but just empirically, and I think based on forward returns from here, we're there, regardless of how people feel.
Doug, it's really interesting that you're talking a lot about these sort of bubbly valuations, because we talked to Ed Yardeni earlier today, and he has a new target for the S&P 500 by the end of next year to reach 7,000. And he too brought up valuations, but in his view, earnings growth is going to be able to grow quickly enough that he thinks valuations, and here we're showing his chart of valuations going higher really across the board from small all the way up to mega caps. He thinks earnings growth is going to be able to be robust enough that things will not continue to look as expensive. What do you think of that view?
I'm skeptical of that argument with respect to the large and the mega caps, because that's where the margin expansion has been historically. So expanding margins from here, let's say for the average S&P 500 stock, I think is going to be really tough. But he's not wrong when you look at mid and small cap margins. I mean, they're somewhat above historical averages, but they're not exceptional. And at the same time, valuations on small caps and mid caps are pretty average. I'd say on small caps, they're dead on their long-term historical averages. For mid caps, we'd say, they're maybe on the high side of their neutral zone, but certainly there's no reason to dump mid and small caps on a valuation basis. I mean, if you're worried about a recession next year, then yes, you probably should. But we just put out a report last week looking at what mid and small cap returns could be over the next several years. And to us, they look maybe average or just shy of average, whereas the same exercise, and again, when it comes to managing money, our long-term return forecasts are not a big part of what we do, but we do look at them to assess the overall risk environment. But our forecast for the S&P, derived from many of the same measures, would say more like 3% returns looking out several years, and average returns, again, for mid and small caps. So I do think there's much better value there.
Let me ask you, Doug, got your view of the broad kind of gauge there, but under the hood, I'm curious, what sectors would you favor here, Doug? Which ones would you be selling?
We've been trimming back on our tech holdings here for a number of months, and we're underweight tech now relative to the S&P for the first time in at least a couple of years. What we're seeing sort of bubbling up, if you will, in our industry group rankings is more value-oriented groups, and in particular, financials. We're now at 24% financials in our select industries portfolio. We have bought regional banks, the reinsurers, and also P&C insurers. So And that's the quantitative work speaking. And what's interesting is very often we don't have a good narrative for a while until we've been in those groups for a while. In other words, the quant work sort of sniffs it out first, and then we start to see the fundamentals fall in line, and then the narrative kind of develops. So I don't have a great story other than, higher inflation would clearly benefit the P&C insurers, and it has of late. And there has been a relationship between higher interest rates, higher bond yields, and the bank stocks outperforming in the recent past. So those are a couple of reasons, but I think it will become more obvious if those moves persist as to why we bought them a while back. But overall, I do see a rotation away from the large cap growth leadership that has just dominated throughout this bull market, and quite frankly, even throughout the prior bull market. I do finally think that leadership torch is being passed over to value and to secondary stocks, small and mid caps.
Well, certainly that group has a lot of fans right now. We'll see how it plays out, Doug. Great to see you.
Right.
Thank you so much.
Great to see you. Thank you.